You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and market volatility can really feel like an emotional roller coaster for investors. One day you're celebrating gains, the next you're watching your portfolio value fluctuate dramatically downward. And the first half of 2025 was really particularly turbulent. We had major market swings due to tariff concerns, geopolitical tension, and economic certainty. During these unsettling times, you may be asking, what should you be doing? How do you navigate this volatility? So today, and volatility is an inevitable circumstance in markets. We never know the cause of volatility before it happens. But if there's two things that I feel like are certain about the markets, it's that they're unpredictable and that they can be very choppy and volatile. So today I want to talk about specific strategies, tools, and approaches you can use to protect and grow your wealth even during market turbulence. Some of that could be understanding human behavior. Should you be doing tactical rebalancing of your accounts? How can you look for strategic opportunities? So how do you plan for and adjust to volatile markets? So we're going to talk about investment strategy implementation, how to navigate volatile markets. We're going to talk about human behavior and how you can keep yourself from making costly emotional decisions. Then we'll talk about portfolio protection strategies. Are there some moves you should make while volatility is going on? And then finally, looking for opportunities and turning market volatility into wealth-building opportunities. So we'll talk about specific techniques and strategies that can guide you through uncertain times. Understanding these actions can help you appreciate the true value of disciplined preparation and execution during market stress. So let's dive into this. Let's start with navigating investment volatility. Let's give some context first. In 2025, of course, as we know, stock markets dropped significantly following the Trump tariffs. And believe it or not, 401k money flows for the month of April was 4 times normal activity in 1 week, meaning money being changed in the 401k, people going in and changing from one fund to another. It was 4 times the amount of activity than what is normally seen in that 1 week. That was when the tariffs happened. Now, over half of the outflows, 53% of the money coming out of funds in 401ks were coming out of large cap U.S. stock funds. And 52%, so almost an identical number of where they went into stable value funds for safety. So think about this. At the moment the market cratered 8-9% in a week, while they were down, people were exiting stock mutual funds and going into stable value funds. Of course, then a couple of weeks later, Trump announced the pause on the reciprocal tariffs, and we had almost a 10% gain in the S&P 500 in 1 day. So how do you navigate this? And how can you take emotion out of the equation as much as you can? We're emotional beings. And that can be a good thing. It can be a bad thing. In investing, it can be a dangerous thing. So first, you should be identifying risk and planning for risk prior to market volatility. We're back near all-time highs in the market. Dow's at an all-time high after yesterday. S&P's close. Now's a great time to assess your portfolio and the risk you want to be taking. We plan ahead for risk. Now, how do you do that? You can measure risk in a portfolio. We've got some great tools now where we can now, what does that mean, measuring risk in a portfolio? That's taking any investment or any group of investments and measuring risk statistics. Now, to do that, the machine, the software, whatever the intelligence is that's analyzing that, is analyzing historic data of these investments. So it's certainly not foolproof, and we know that past results don't predict the future. But measuring risk has proven to be somewhat of a reliable indicator of future risk. Not how much are you going to make or going to lose and where the market's going. But if the market does X, what can you expect from your portfolio? And as we know, it's not exact, but it can give us some idea that when there's a 30% downturn in the market, what can you expect out of your portfolio? And it'll at least give you an idea. Now, you could get results outside the norm, especially when things happen more quickly than normal. A perfect example is the pandemic of 2020. Typically, a deep bear market, we see a deep bear market, meaning the market goes down a good 35 to 40%. This is the U.S. stock market. We see that about every 7 to 8 years. Now, by definition, bear market means the U.S. stock market declines over 20% from a previous high. But a typical deep bear market, 35 to 40%. Well, that normally takes 9 to 12 months to get from the high in the market to the low. And in the pandemic in 2020, the market went down 35% in 4 weeks, as opposed to 9 to 12 months. And in a typical deep bear market, it takes 3 to 4 years to come back. In 2020, it took a few months. When that happens, you might see more participation in gains. In other words, you might lose a little more than you expected. You might get unexpected results. So in other words, when you measure past risk and you figure, hey, if markets, if we were to repeat a 2008 where the market was down 36.8%, how much would you expect your portfolio to lose? Let's say the number's 25%. Then, if we had it, if it happened in rapid fire succession, you might, it could be a little more distorted. But the bottom line is measuring past risk is a pretty good predictor of future risk. And so measuring the risk and defining the risk that you're comfortable with in your financial plan and having your own investment policy. Your investment policy should represent things like risk tolerance. What's your time horizon before you'll need investments? What are your investment objectives for 2 years, for 5 years, for 10 years, for 20 years? And an investment policy would also be asking the question, how much can you tolerate losing in a deep downturn? I found that how much people want to make on their investment is somewhat a function of how much you're willing to lose when things go badly. So we should be planning for this volatility before it happens. Now, that's probably the most important thing you can do to prevent making a poor emotional decision. Now, then another thing you need to do is make sure that you have proper diversification. And I've talked about this a good bit over the last few weeks. So I tell you what, I'm going to stay on this first point about volatile strategy implementation because It really needs a couple of segments. So when we come back, I want to talk about proper diversification. Even within, are you as diversified as you think you are? If you own the S&P 500, how diversified are you? And if you have a diversified stock portfolio, how diversified is that really? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living here on News Talk 98.7 WOKI. We're with you every Saturday from 9 to 10 a.m. and again from 3 to 4 p.m. And today we're talking about navigating stock market volatility. We've had a choppy, especially first 6 months in the market. And so, my biggest takeaway in that first segment is plan for volatility before it happens. And one way you do that is by measuring risk in a portfolio and then developing your own specific investment policy that looks at things like balancing risk and reward. How much you want to try to make on your money is somewhat a function of how much you're willing to lose when markets are poor. It's also very much a function of how long will it be before you need your investment. If I'm 40 years old and I have a 401k, I'm not going to touch till I'm 60 or older. I can take more risk than if I was 63 and needed to start drawing from that money in 3 years. How long is it going to be before you need your money? But what about diversification? The idea of diversification, we think, don't have all your eggs in one basket. And the way I like to say it is, if you have one thing zigs, another thing zags. That way, if one thing's way down, like whatever it is, a single stock or a group of stocks, hopefully they're not all way down. So I hate to use the word hedge because diversification can mean other things other than the word hedge, but the idea is you don't have too many things tied into one thing, right? You don't have everything in one or two eggs. Well, the problem with the markets in the last 5 years is you got to understand how the S&P 500 works, which I've talked about many times over the last 6 months. The S&P 500, of course, we know it's an index made up of 500 of the largest U.S. stocks. But it is not an equal weighted index, meaning, it's not every one of those 500 companies has an equal, a 1/500th impact on the movement of that index. It is actually a weighted average index, meaning the larger a company is, the more it has an impact on the movement of that index. Well, we've got these big mega cap stocks now, and there's been a lot of talk about the Mag 7, which are all technology stocks. NVIDIA, Microsoft, Apple, Alphabet. There's 7 of them. And Tesla. They're all in technology, and they now are driving a very, very large percentage of the market. If we take the top the 500 stocks in the S&P 500, and we look at the market capitalization, how big are these companies, which is basically their outstanding stock shares times their current price. The Magnificent Seven make up over 35% of the S&P 500 market cap. And believe it or not, the top 10 stocks make up 40%. So in other words, 40% of the movement of that index is those top 10 stocks. And we now have what I would call the Magnificent Two. The largest two companies, NVIDIA and Microsoft, now account for 14.9% of the entire S&P 500. So if the idea behind diversification is to not have too many things in one thing, well, there could be an issue there, right? If 35, 36% of the S&P 500 is in these Mag 7 technology stocks, could there be a little bit of a bubble? Well, sure, there could be a bubble. Now, is that like the 2020 or the 2000 technology bubble? No, because back then you had technology stocks that weren't even earning money. and you had tons of them that were small startups. Today, the Magnificent Seven, I mean, look at Microsoft and Apple. I mean, these are big companies making money. They have corporate profits. It's not the same kind of thing potentially as a bubble in 2000. However, if you buy the S&P 500 and you think you're diversified, the reality is you got 10 stocks driving 40% of your portfolio. So that can lead to more volatility. Now, the last 5 years, that's been very good. But there's an old expression, concentration risk, where you concentrate your investment in one stock or one industry group. Let's say a collection of these technology stocks, concentration risk. Concentration risk can get you rich if they pay off. Now, with the benefit of hindsight, we know the last 5 years that has paid off. But diversification will keep you rich. Because if you have too much of your money in one thing or one group of things, you could lose a lot of your wealth in the snap of your fingers. So having a little more diversification in your stock portfolio alone, and then the follow-up part of that is owning things other than just stocks. The stock market has become more and more correlated in terms of the U.S. markets, the foreign markets, how are stocks moving and behaving. They're highly correlated. If U.S. stocks are up, international stocks are probably going to be up, and vice versa. So, when you're diversified within the stock market category, you have what's called systemic risk. What's the risk if the entire market goes down? And there's the old expression, a sinking tide sinks all ships, right? A rising tide rises all boats. If you're diversified in the stock market and the market does well, you're going to probably do well. If it does poorly, you're going to probably do poorly. So what's going to hedge that stock market risk itself? And that's where you own more things that zig and zag. What would be some examples? Things like real estate assets, things like natural resources, things like energy, things like international investment. And I don't just mean international stocks. I mean international investment that hedges the dollar. We've had a decline in the dollar this year. That's one of the things that has led to international stocks doing so well this year, because international stocks are beating the pants off of U.S. stocks this year. Now, U.S. stocks have been beating the pants off international stocks for close to 15 to 20 years. But this year, it's been the other way. So it's having true diversification. Having levers in the portfolio that when one thing's significantly down, you got other things that are not down as much, so you don't see as much volatility. And I will say, when you're creating more diversification within just the stock market universe, you're not necessarily giving up upside potential. You're just adding more diversification that provides more balance of asset classes in choppy markets. So, number one, we plan ahead for risk before it happens. We do that by measuring risk in a portfolio. We develop a formal investment policy that outlines our goals, objectives, our risk tolerance, balancing the risks and rewards that come with stocks and investing in general, and being sure you're properly diversified, first off, just within the stock market universe. But then secondly, do you need other things other than just the stock market? If your time horizon is less than 10 or 12 or 15 years, you probably need more things other than just the stock market. But volatility is part of the game. So we just need to understand that. And there are some groups of stocks, blue chip stocks, big bellwether U.S. stocks that have less volatility than technology stocks. So having a diversification of all this, don't get me wrong, I think you should own some of the mega cap stocks more than likely. To qualify that, I don't know your personal situation. But if you're going to have risk and you're going to have stock market investment, you should probably own some of that. Excuse me this morning. But you have to be careful you don't own too much of it. And then when you do all these things, you measure risk, you develop investment policy, you look at your goals and objectives, risk risk and reward and you're properly diversified, you can stay the course a lot better when we have inevitable stock market volatility. Because you've planned for it, hopefully you don't get an outcome that's radically different than what you were expecting. Now, deep bear markets are always uncomfortable, and we're creatures of emotion. But if you have a proper plan developed around that, you can sustain that. The other thing is you've got to have money you can depend on in the short term that's not at risk. One of the real keys to wealth management is that you don't spend a significant investment loss. You don't want to sell in a down market is a way to think of that. Now, I would further clarify that it's okay to sell something and reinvest it, but it's not okay to sell it and spend it when then it's gone. You've compounded your loss. That money will never come back because you've spent it. So, if the market's down 20, 25, 30% and you need money and all your money's in the stock market, then you're going to have to sell it when it's down and then spend that money. You'll compound your loss. And that's what you can't do. So you've got to have some more stable and safe assets that you can depend on when you need money. Now, when you get near retirement, the thing that really jumps out there is needing income in retirement. So your short-term income needs should be met with things other than market risk investments. So things like CDs, treasury bills, short-term bonds, things like that, things that have stability or even guaranteed protection. Now, when I say guaranteed protection, you've got to look at who's backing that guarantee. If you have an FDIC-insured bank, the bank is backing the money, and then there's a fallback with the FDIC, as an example. But it's somebody's backing that. If you have a AAA rated corporate bond, that's a very solidly rated bond. It's not insured, but it is backed by a solid company. So you got to look at those kinds of things. But things that are stable or protected is what you need to depend on in the short term. And then you're not as worried. I mean, think about this. Let's say you're retiring a year from now. And you say, Jim, I need to start drawing income. Let's say you need to start drawing $50,000 a year from your investments, and you've got, let's say, $1.5 million. That's a 3% draw rate. With a good investment plan, you ought to be able to accomplish that. But what if in the next year we have a deep bear market and the market goes down 30 or 35%? You may feel like you can't retire now. But if you've planned for that before it happens, and you have some more protected and stable investments that aren't down substantially, then you've got time on your side to let the at-risk investments recover, and you can go ahead and retire. Market instability should not be driving your ability to retire. And then finally, pay attention to data rather than narrative-driven market moves. When the market moves, the media sensationalizes everything. And it's important to look at the data. And it's important to understand the difference in hard data and soft data. Soft data is things like consumer surveys, business sentiment. It's soft. It's not hard. It's kind of like, how are people feeling and what do they think about things? Consumer confidence. Hard data is, what does the actual hard data say? Now, you could say soft data is more of a forward-looking thing and hard data is more of a backward-looking thing. And I think there's some wisdom in that. But the hard data that continues to come in is that U.S. companies are profitable. Now, we're starting to see some cracks in some of that. But with that, that's not what this show's about, is current economic, where we headed. But the bottom line is, pay attention to hard data and be careful not to be distracted by narrative-driven sensationalism in the media. Okay, when we come back, we're going to talk about human behavior and making sure that you don't make emotional decisions at the wrong time. So stay with us. This is More Living with Jim Brogan, right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. I want to invite you. I've got a one-night class through Pellissippi State Tuesday night. Income planning for retirement, specifically the challenges. How do you structure income that does not depend on stock market stability? Because stock market stability, eventually, if we have some of that, it ends, which, of course, we're talking about volatility today. But then how do you grow income in the long term? And, because if, retiring at 65 today, inflation is as big a risk as what you face. And you need long-term growth. But you just can't depend on the stock market for short-term income needs because the market's completely unpredictable. I talk about all these things in this income planning class. I also talk about income taxes, Social Security, election, how your income may affect Medicare premium, all these kinds of things. It's Tuesday night, Pellissippi State, 6:30 to 8:30 p.m. It's at their Hardin Valley campus. For more information, you can go to PellissippiRetirementIncome.com. Again, PellissippiRetirementIncome.com. You can download a syllabus and click to register. You can also call Pellissippi State directly at 539-7167. Now, they won't be open this weekend, but give them a call. You can leave them a message. They can call you Monday so you don't forget to register. I'd love to see you there. Now, if you want all my upcoming classes for this fall, go to broganfinancial.com and click on classes, and you can see the additional classes we have through both the University of Tennessee and Pellissippi State. Today, we're talking about navigating market volatility, and I want to talk a little bit more about human emotion. Investment strategy is certainly important. One of the most valuable services that we can provide during volatility is behavioral coaching. Human emotions often drive investors to make exactly the wrong decisions at exactly the wrong times. And recent data shows that investor behavior during this year's volatility perfectly demonstrates why managing emotion is so important. Investors experience significant anxiety during the tariff-induced market swings. Many investors wanted to abandon their long-term strategies due to short-term fear. So it's important to remember several things here. One, volatility is part of the game. It's normal. We want to focus on what we can control, measuring things ahead of time, understanding risk versus reward, having some protected or stable money to draw from when markets are down. So that allows you to focus on staying the course, helps with our emotions. We should revisit our allocations on a regular basis. What if things are out of balance? Could you have less diversification than you realize? You should have a margin of safety with assets you can depend on that are protected, as I mentioned. Now, then one other thing I think you've got to understand is a new risk that you take on when you retire that workers do not face as much, and that's sequence of return risk. What is sequence of return risk? Sequence of return risk is when are the good years and when are the bad years in the stock market? We know that over time, the market does, now what does that mean? Could mean 15 to 20 years, but the stock market has been really the best way to beat inflation. But when are the good years and when are the bad years? And that becomes a more important issue when you retire because you're no longer, number one, you don't have time to recover losses or as much time. Number two, you're not investing money while markets are down. See, one of the best things when we're younger and we're contributing to a 401k is we take advantage of market volatility. Because when the market is sharply down, we're investing more money while it's down. So think about this. You got a 401k and you got X dollars in it and the market craters and goes down 25%. Let's say you're a long-term investor and you lose 25%. Well, you're not going to like that, but in the meantime, every paycheck, you're adding more investment while the market is down. So when the market comes back to just where it was when the bear market started, you're in the green. Because the investment, the principal you had in there when the market downturn started is back to break even. But all those investments you made in the weeks and months while the market was down, all of those investments have made money. So the market is flat, but you've made money. Well, in retirement, you don't have that ability. And further, if you are taking withdrawals while markets are down, then the market may be flat. You've actually lost money. It's the opposite of investing money. So it's the first 5 years of retirement is the most critical. If markets are sharply down in that first 5 years and you're selling off market investments for income purposes, it could be absolutely devastating. So it's critical to get through that first 5 years, and I really like to say get through the first 6, 7, even 10 years, where market volatility just would not have as much impact on your financial plan and would not impact your income. Difficult markets often lead to emotional decisions that are not in your best interest. Panic selling often means missing recoveries when cash sits on the sidelines. Many of the best days in stock market history have immediately followed some of the worst days in stock market history. A great example of that is what happened on that tariff pause in April, where the market shot up almost 10% in one day. If you were in cash, that was pretty painful to see that market shoot up like that if you had sold and gone to some cash. Now, here's something else. Since 1980, 45 years, the S&P 500 in a typical year sees a drop in the market of 14%. So 45 years, 1980 through 2024, the average stock market correction in those years was 14%. Yet 75% of all those markets ended up being up. So 75% of all those years, the stock market was up, yet the average downturn within that year was 14%. Market corrections are normal, and in many cases are healthy to markets. So we got to stay the course, avoid market timing mistakes, take advantage of opportunities. One of those is investing when markets are down, when you're investing through your 401k. If you're already retired or getting ready to retire, or younger, it's looking for other opportunities when markets are down. So all these things are very, very important. Now let's talk about tactical strategies. Are there things that you should be looking at tactically? Some recent research from Morningstar has shown which investment approaches have been most effective during the 2025 market turbulence, and the findings may surprise you. Lower volatility funds, which typically are comprised of more value-oriented stocks. In the April tariff sell-off, the broad market lost 9.1%, but low volatility funds lost 4.5%. And international low volatility fund strategies performed even better, with some gaining 3% during the market decline. And some of these low volatility strategies don't just own the least volatile stocks, but they use optimizers. They don't just buy low volatility stocks. They have measurements they can use, fundamental measurements to help measure which is, sometimes a stock is selling at a discount because it's an ugly stock. It's just not a good stock. But sometimes they're selling at a discount for reasons that don't make a lot of sense, and there's opportunities there. Now, moving forward, we don't know what's going to do best, but this goes back to what I mentioned in my first segment today about diversification. If you're just on the S&P 500, you weren't as diversified this year as if you had owned some blue chips, low volatility stocks to go along with the Magnificent Seven stocks, and then look at the international market. The international market has been tremendous. We've gone through such a long period of time that the international market has been outperformed by the U.S. stock market. You know, it's easy to get lulled to sleep. Do I think you should have more U.S. stock exposure than international exposure? Yes, I do. But you should have some international stock exposure because we go through ebbs and flows, peaks and valleys, and that's the type of diversification. And then be looking at your asset allocation, reviewing that during periods of downturn. Actually, you know, asset allocation review should be just as important in periods of upswings. You know, our markets are back near all-time highs. The Dow closed at an all-time high yesterday. The S&P is almost at an all-time high. This is a time to be looking at portfolio asset allocation as well. How long has it been since you rebalanced your 401k? If you haven't really been paying attention to your asset allocation, it may be you're overly invested in the Magnificent Seven, and you're subject to more potential risk. So it's understanding all of those things. And then rebalancing opportunities do emerge when some assets outperform others. And we do have to understand rebalancing at its core is emotionally counterintuitive. We are selling off a little bit of the stocks that or the funds that have made the most amount of money, and then we're using that money to buy more of the funds that have done worse. So inherently that seems counterintuitive, but this year's rise in international stocks is a perfect example of why some rebalancing can be important. Now, how often, when we say periodic rebalance, I'll be honest with you, if we look at data and research from history, you should not be frequently rebalancing your portfolio. Now, what does that mean? Frequently, I would say either monthly or quarterly. There's probably something to be said for looking at your portfolio and maybe rebalancing annually. Now, there have been some studies show you shouldn't rebalance but for 3.5 or 4 years. My take on it, you know, I believe in the momentum of asset classes, and when I say I believe in it, that's not my opinion. It's based on science and research. So if you rebalance too frequently, you could end up choking off positive returns. So my preference, and the way we do it at Brogan Financial, is we rebalance. We just monitor the portfolios. We don't have an automatic rebalance. We watch them. We're looking at market trends. If we have an asset allocation range, let's say we want U.S. small cap stocks to be between 6 and 12% of a stock portfolio. Well, if I'm bullish on small caps or if they're lagging and selling at a discount, I might want closer to 10 to 12%. If we've had a huge run in small caps or I'm bearish about the economy, I may pare back to 6 or 7 or 8%. But I'm going to stay in these ranges because that's what a disciplined investor does. But we are going to look for opportunities to take advantage of. You know, on the subject of small cap stocks, they've underperformed for 5 years. And small cap value stocks, historically over long periods of time, have been the number one asset class to invest in. But they've lagged for the longest period of time we've seen. And so we should probably be looking at our allocation. Should we be going to 12% as an example? Not necessarily. And by the way, let me be clear. When I say 6 to 12% on small caps, I'm not saying that's what we do for people or that's what you should do. I'm just using an example. Okay, so don't rush out there and take that as, oh, that's what I want to do for my stock mix. That's not what I'm saying at all. So I want to be super, super clear on that. Now, when we come back, I'm going to dive into one other topic that I think is critically important to understand, and it's understanding yield on investments and being careful that yield is not the driver of your investment decisions. Because there's a lot of stuff out there in social media and advertisements about high yield, like 20, 30%. Be wary of chasing the wrong kind of yield. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. Check us out online, broganfinancial.com. We got a wealth of information. You can click on resources. You can download free guides. You can click on radio and listen to podcasts of all our shows. By the way, you can also go to Spotify and Apple Podcast and listen to our shows and stream them through those services or download them. So we want to give you a wealth of information so you can make informed and prudent decisions that can impact the quality of your life. My upcoming class, Retirement Income Planning for Retirement, is a one-night class through Pellissippi State on Tuesday night, 2 hours, one session, to cover as much of the things as I possibly can in 2 hours that you need to know about income planning for retirement, including taxes, Social Security election, market volatility, all those things. So you can go to PellissippiRetirementIncome.com. For all of my upcoming classes, you can go to BroganFinancial.com and click on classes. We're coming up here at the University of Tennessee's Adult Education and through Pellissippi. For this last segment, I want to talk about the illusion of yield. You know, if you're on any kind of social media, you may have seen headlines about funds that boast 30% yield, and retail investors are rushing in. There are even Reddit communities right now where people claim they can borrow at 10% and pocket the spread because of the yield, or use these funds to pay back long-term debt by borrowing even more with margin. The problem is that the yield in these cases is not really yield. In many cases, it's the return of principal. You know, traditionally, yield meant the income an investment produced, such as bonds, bond coupons, or stock dividends. It was real cash tied to income from the underlying asset. But with many of these strategies we see with exchange-traded funds, many of these are option-based products, and what gets labeled as yield often comes from, I don't want to get too technical, it's from option premiums that are distributed even if they exceed actual returns. So here's what that means. When we look at total return of an investment, there are two components to total return. There's the dividend yield, or the interest that's paid, and then there's the appreciation or depreciation of the investment. So if a fund is distributing 10% yield, but it's only making a total return of 5%, you have a 5% net loss. So when funds advertise these high yields, we have to be very wary and cautious. In the true sense of yield, meaning income from an investment, to get high yield, you have to buy things like junk bonds or stocks that have high yield because the stock is way down, might have a lot of warts. You know, there's a reason it may be way down, or there may be a reason. So we have to be very careful about funds that promise high yield. There's also a tax trap. These structures often manage to turn yield into one of the least efficient forms of income possible, because distributions are taxed at the higher short-term tax rate that cannot be offset with long-term capital losses elsewhere, including if the fund itself loses money. So sometimes margin can be a mirage. So the way I think you need to think of yield is it's what your investment actually generates in sustainable cash flow, and it should be paid out in the most tax-efficient means possible. That's why we work hard to develop structures to achieve greater outcomes pre and especially post-tax. Distribution should be tied to the long-term real returns from an underlying asset and not engineered in a way that leaves investors worse off after taxes and fees. Thanks for tuning in. This week we've discussed market volatility and the illusion of yield, because greater wealth provides for more living so you can live the best years of your life your way. I want to thank Wayne for engineering the show today. I want to thank Mary Caroline for helping produce the show. Check out our next class, Pellissippi State. It's retirement income planning. You can go to PellissippiRetirementIncome.com. It's this Tuesday night, 6:30 to 8:30 at Pellissippi Hardin Valley. Thank you for tuning in this week. This has been More Living with Jim Brogan here on News Talk 98.7 WOKI. Have a very blessed
Jim Brogan
weekend.
And his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.